Hello guys, welcome to my channel again. This is Wyse Capital FX. First things first, I really like you to hit the subscription bell and give us a thumbs up and also share this content with your friends. Today we'll be talking about spreads, and I'm really hoping that when we are done with this presentation, we'll be way much ahead in understanding the basic stuff that are really involved in the financial market trading. But before we go deeper, I'd like to take you through the disclaimer. Trading the financial market on margin carries a high level of risk, and these might not be suitable for all investors or traders. And our past performance is not a guarantee that our future trades will work. The high degree of leverage can work for you and as well as against you. Your capital is at risk. Therefore, you are encouraged to use proper risk and money management tools. Please head and write to us at wisecapitalinvestment@gmail.com should you have any queries. Leave a comment in the comment section below. Should you have a topic that you want me to prepare a video on, I'd really love to hear that from you. Also, give me a general comment. Tell me what you think about this presentation. Tell me what you love to hear. Also, in the description below, there is a link to my WhatsApp group. Please click on it and I'll be able to see you on the other end. You can also follow us on Facebook at Wyse Capital FX Trading Academy, and we hope we'll interact more and more as we continue learning. Today's presentation is more of basic stuff that you need to know as a beginning trader. The breakdown of presentation is we look at what is going long and short, or buy and sell. What do we mean when we buy or sell? What is the mechanism involved when you place a buy or a sell order? We'll also look at the base and the quote currency, and then we'll look at what really is a spread. After that, we'll look at the concept of bid and ask. When I explain the concept of long and short in the Forex market, I want to use a real business example and a business that you know to explain this concept. Now, to the newbies, going long simply means buying and going short simply means selling. So how does it really work in the financial market? So when you go along, when you take a long position, it simply means that you believe that the value of an asset will increase so that you'll sell it later at a future date and make a profit. So if we compare this to a real business, let's say a tangible product, maybe you deal with electronic goods, yeah? So you have your supplier who will supply you cheaply with this good. So let's say you're dealing with a piece of radio. So we have your supplier giving it to you at maybe $100, right? So you're buying it cheaply from your supplier. Then you'll go sell it to your customers expensive. Maybe you sell it at $150. You make a profit of $50 because if you subtract your selling price minus your buying price, that is exactly what you remain with. So we're going to jump to the charts, and we are going to have a look at really how that one works in the Forex market. In a Forex trading chart, there are areas where buyers find value, and also there are areas where sellers find value. Where buyers find value, these areas we call them support zone. For example, in this chart, you see whenever price comes to this, the gray zone that I've highlighted, price is being rejected, meaning that buyers are finding value at that point. It comes almost 4 times, and each time it comes there, it tends to be pushed all the way back upwards. What this tells you as a trader is that you can get a very fair price at that area, which is a support zone. Once you buy that asset at that point, the value will increase. As price increases, it will be more of you bought something, then you're waiting for it to increase in value, and automatically when you close the order, it will be like you've placed a sell order to the next customer, and you'll be able to keep the profit. So you buy low and you sell high. You buy low, you sell high. That is the concept of going long. When you place a sell order, in other words, we say that you've short the market. But now the question becomes, how do you sell something that you don't own? And this is something that majority of new traders cannot explain. And then it comes down to a simple fact that you really don't understand how the business operates. Because if you say that you're a trader and somebody asks you, how does a sell order operates, and you cannot explain how you can sell something that you don't own, I mean, it tells a lot about you. So in this section, I'm going to explain how it really works. I'm going to use a real business example. From our previous example in the buy order, we used that you are buying radios from your supplier and you're going and selling them expensively, and you make a profit of selling price minus buying price. That one is a rather straight forward process. But when we look at a short position on where you are selling something that you don't own, it comes down to basic assumption that you must have a good relationship with your supplier. Therefore, you will borrow a radio from him, or you'll borrow some radios from him. You are a trader and you've done your analysis in the market, and you've seen that in 2 months' time, the value of this radio will reduce because maybe customers are not responding positively to this product. So this product, you'll go to your supplier and you'll tell him, my friend, I want you to lend me some radios. So let's say your supplier lends you around 10 radios. After the 10 radios, now you go and sell them at the market at the current selling price. So you go sell them at $150. So with that, you'll have made around, remember the 10, you'll have made $1,500. So that will be the cash you'll have at hand. But the agreement was after 2 weeks, you return the radio back to your supplier. So 2 months down the line, if the value of the radios drop like you had anticipated, they drop to maybe $50, you buy back the 10 radios that you had borrowed at 50, you spend around $500. So if you subtract $1,500 from $500 that you are being forced to use, remember you had a cash of around 150 from your previous business of selling these radios at 150. So you buy them back at 500, then you take back the radios to your supplier. What you'll have realized, you'll have remained with a net of $1,000. And that is how you sell something that you don't own in real business situation. So how does it work in the Forex market? Now again, we assume that because you have a broker, now you have a good relationship with your broker. So you'll borrow a specific currency, then you'll go and transact with it, you'll go do business with it, you'll go short it. Therefore, when price drops, you'll buy the product back and take it back to your supplier. Now you realize the only way you'll make a profit in this deal is only if price drops. I really hope this is clear. Should you have missed something, please comment below so that maybe I could redesign this video so that it becomes very clear, or better still, I could write a material about it and to explain it further. In a Forex chart, there are levels where you can easily place a sell order and you'll be able to make a profit. These levels are called resistance zone. These are areas where sellers find value and they short the market, and as a result they make profit as price drops. So like in our previous example where you borrow radio and you go and transact with it and then you make a business, the only way you make profit is only if price drops. So in a sell order, the only way you'll make a profit is only if price drops. So automatically when you place a sell order, your broker, it's like you've borrowed your broker this currency pair and you want to deal with it in your own business. But since you've borrowed, you must return it to him, whether price increases or drops. So if you place a sell order and the price drops, so automatically when you close the position, the products will go back to the broker. Nobody will tell you that right now you're borrowing or right now you're selling to return to your broker. It happens automatically behind the scenes, but that is the process. I really hope with this that now you should be able to explain how a long position operates and as well as how a short position operates. When you are trading the Forex market, it involves two transactions happening at the same time. For example, you must have known that currencies are quoted in pairs. So we might have Euro USD, Pound Dollar, etc., etc. The first currency in the quote is what we call the base currency, while the second currency in the pair, for example, in Euro USD is the second currency in the quote. So this is what we call a quote currency. Now, your focus as a trader is always on the base currency. For example, when you go long Euro USD, it simply means that you've bought Euro and you've sold USD. From the basic definition of Forex, it means foreign exchange. It means you're exchanging one currency to another. The way I like to explain this, it's like your broker is asking you, between Euro and USD, which one would you prefer to hold? Or which one would you prefer to lose after you've done your analysis? If you prefer to hold, it simply means that you believe that the value of that currency will increase and you will make profit as price increases. So in a pair, the first currency is what we call the base currency, while the second currency in a pair is what we call the quote currency. Before I address the issue of spread, there are two things we need to look at. That is the bid and the ask price. The bid price is the price at which you can sell the base currency, while the ask price is the price at which you can buy the base currency. So this is what will happen. In our example here, you can see Euro USD 1.1895 stroke 1.1892. So the first part, which is 1.1892, is the bid price, while the second part, which is 1.1892, is the ask price. So this is what will happen. When you place a buy order, your broker will execute it to you at the ask price, which is 1.1892. While when you place a sell order, your broker will execute it at 1.1895. Then spread is the difference between the bid price and the ask price. Simply put, spread is the cost you pay for buying an instrument or a financial asset. Let's compare it to any other business. Suppose you're a car dealership, you import vehicles and you sell it locally. So there is a margin you'll attach on top of your buying price. Then that margin is what you'll charge people, and that is actually what brings about your profit. So that charge that you're paying is what we consider as a spread. Now we bring that to the financial market. Every pair has its spread. Major pairs have relatively low spreads, followed with the minor pairs. Then the exotic pairs have a very strange spread. Sometimes they are very expensive. So simply put, a spread is the cost you pay for buying a financial asset. This is how the brokers make their money. So in our example, Euro USD 1.1895 subtract 1.1892, which is equals to 0.003, which actually is equals to 3 pips. So a spread is measured in terms of pip and it is paid upfront. No wonder every now and again when you place an order, it first of all starts with a negative because your broker has to be paid first. So whether you like it or not, the brokers will always make the money even if you don't make money, because they'll always charge you first, right? With that, we come to the end of today's session. I really hope you've enjoyed and I hope you've learned something. Please subscribe to this channel so that you get updates, and also like and share to your friends. Till next time, goodbye for now.